Investing your money is the most reliable way to build wealth over time. If you're a first-time investor, we're here to help you get started. It's time to make your money work for you. Before you put your hard-earned cash into an investment vehicle, you'll need a basic understanding of how to invest your money the right way. However, there's no one-size-fits-all answer here. The best way to invest your money is whichever way works best for you. To figure that out, you'll want to consider your investing style, your budget, and your risk tolerance.
First, let's start with your style. How much time do you want to put into investing your money? The investing world has two major camps when it comes to the ways to invest money: active investing and passive investing. Active investing means taking time to research investments yourself and constructing and maintaining your portfolio on your own. To successfully be an active investor, you'll need three things. Time. Active investing requires lots of homework. You'll need to research investment opportunities, conduct some basic analysis, and keep up with your investments after you buy them. Knowledge. All the time in the world won't help if you don't know how to analyze investments and properly research stocks. You should at least be familiar with some of the basics of how to analyze stocks before you invest in them. Desire. Many people simply don't want to spend hours on their investments. And since passive investments have historically produced strong returns, there's absolutely nothing wrong with this approach. Active investing certainly has the potential for superior returns, but you have to want to spend the time to get it right. On the other hand, passive investing is the equivalent of putting an airplane on autopilot versus flying it manually. You'll still get good results over the long run, and the effort required is far less. In a nutshell, passive investing involves putting your money to work in investment vehicles where someone else is doing the hard work. Next is your budget. How much money do you have to invest? You may think you need a large sum of money to start a portfolio, but you can begin investing with $100. The amount of money you're starting with isn't the most important thing. It's making sure you're financially ready to invest and that you're investing money frequently over time. One important step to take before investing is to establish an emergency fund. This is cash set aside in a form that makes it available for quick withdrawal. All investments have some level of risk, and you never want to find yourself forced to sell these investments in a time of need. The emergency fund is your safety net to avoid this. Most financial planners suggest an ideal amount for an emergency fund is enough to cover 6 months' worth of expenses. While this is certainly a good target, you don't need this much set aside before you can invest. The point is that you just don't want to have to sell your investments every time you get a flat tire or have some other unforeseen expense pop up. Another important aspect is your risk tolerance. How much financial risk are you willing to take? Not all investments are successful. Each type of investment has its own level of risk, but this risk is often correlated with returns. It's important to find a balance between maximizing the returns on your money and finding a risk level you are comfortable with. For example, bonds offer predictable returns with very low risk, but they also yield relatively low returns of around 2 to 3%. By contrast, stock returns can vary widely depending on the company and time frame, but the whole stock market on average returns almost 10% per year. What should you invest your money in? Here's the tough question, and unfortunately there isn't a perfect answer. The best type of investment depends on your investment goals. But based on the guidelines discussed above, you should be in a far better position to decide what you should invest in. For example, if you have a relatively high risk tolerance, as well as the time and desire to research individual stocks and to learn how to do it right, that could be the best way to go. If you have a low risk tolerance but want higher returns than you'd get from a savings account, passive investing might be more appropriate for you. If you're like most of us and don't want to spend hours of your time on your portfolio, putting your money in passive investments like market index can be the smart choice. And if you really want to take a hands-off approach, a robo-advisor could be another option for you.
So at the end, why investing is important? Investing is the most effective way we can build wealth and save for long-term goals like retirement, paying for college, or buying a house. And the list goes on and on. The sooner you begin investing, the sooner you can take advantage of compounding gains, allowing the money you put into your account to grow more rapidly over time. Your money earns money, without you doing anything. You're looking for your investments to grow enough to not only keep up with inflation, but to actually outpace it, to ensure your future financial security. If your gains exceed inflation, you'll grow your purchasing power over time. Starting to invest can be the single best decision of your financial life, helping set you up with a lifetime of financial security and a happy retirement. If you would like to open a brokerage account to start investing, you can use the referral link below in the description and open it today for free. I would love to hear your thoughts. If you like the video, please give it a thumbs up and subscribe.